Hi, I'm Elliot from Free Life Financial, and today I'd like to explain the home moving process while you already have a mortgage. If this is your first time watching, then please like and subscribe, clicking the subscribe button below. So if you already own a property with a mortgage and you're thinking about moving, you're probably wondering, how does it work? Do we pay off our current mortgage and take a new one? Or do we take our current mortgage with us? Do we move into our new home on the same day that we move out of this home? And it can all sound a little bit daunting. I'd like to give a breakdown of how that all works. The good news is it's not that complicated. The first thing you need to do is work out your equity. This is the money that you would have left over if you sold your property and repaid the mortgage. To work out what your equity is, you'll need to find out two things. One, how much do you currently owe on your mortgage? How much would it cost you to repay your mortgage, including any fees? And two, how much is your property worth? If you do sell it, how much will you get for it? Working out how much you owe on your mortgage should be easy enough. You can sometimes check on your app, but the best thing to do is to call your lender and ask for a redemption figure. There are sometimes fees associated with closing your mortgage account, and a redemption figure will include these fees. If you were using an app or mortgage statements to find out how much you owe, then that should be enough to give you a general idea, but do bear in mind that firstly it might not be totally up to date, and also it might not include fees. Once you know your mortgage balance, you'll know that whatever you sell the property for minus your mortgage balance is your equity. That's the money that you'll have left for yourself and for the deposit on your next property. But we don't know how much you'll sell the property for. You might have a rough idea of what it's worth, but really you'll need to get an estate agent to come and do a valuation of the property. Usually these valuations are free because an estate agent will charge a commission when they sell your property. You might get more than one estate agent to come out to give you valuations because they might give you different valuations, but also they might charge you different amounts for selling the property. So at this stage, you'll know how much your property is worth and how much you owe on your mortgage. You'll be able to work out your equity. If the estate agent says they can sell your property for £100,000 and you currently owe £80,000 including fees on your mortgage, then you know you've got £20,000 equity. This can be used to go towards the deposit on your next property. However, do bear in mind that there are fees associated with moving, so you might want to keep some money back for them. You'll pay solicitor fees, estate agency fees, you might pay stamp duty. These will all need to be covered by your equity unless you have separate savings for them. So let's say that you have £20,000 equity, but the costs of moving are going to be £5,000. That means that you know you've got £15,000 left to go towards the deposit on your next property. Remember, this is all subject to selling your property for £100,000. If you sell it for less, you'll have less cash. If you sell it for more, you'll have a little bit extra. You might also want to save some cash for after you move in. You might want to buy furniture. You might want to just make sure you still have some savings after you move home. At this stage, it's time to start looking at your options for moving. If you want to purchase a property for £150,000, well, you've got £15,000 there for a deposit. So that would be a 10% deposit. You purchase a property for £150,000, you put down £15,000, that's 10%. You then start to look at mortgage options based on purchasing a property for £150,000 with a 10% deposit. If it seems like the numbers work and you're provisionally accepted with a lender and you get a mortgage in principle, then it might be time to start thinking about putting your property on the market. When your house is on the market, you can start viewing other properties, and you could even make an offer on another property. However, in some cases, a seller might not want to accept an offer from you and take their property off the market for you before your property has sold. This will all be down to their preferences. Once your property is sold and you found a new property, you'll then apply for the mortgage on your new property, and the solicitors will start the legal work associated with selling your property and purchasing your new property. Usually you'll try to tie it in so that you move out of your home and move into your new home on the same day. Your solicitor will receive the funds from your mortgage lender for the purchase of your new property. They'll also receive the funds from the buyer's solicitor who's buying your property from you. They'll use the money from your mortgage lender to buy your new property. They'll use the money from the person who's buying your property to repay your current mortgage and for the deposit on your new property. In some cases, you may be using your own savings for the purchase of your new property as well, in which case the solicitor will ask you for this money. Or it may be that you're keeping some of the money from the sale of your property for yourself, in which case the solicitor will give you that money. Now, you may be in a fixed term mortgage, which is when the lender guarantees you an interest rate for a certain number of years, but usually you're tied into that mortgage. If you want to move home and come out of that mortgage during the fixed term, the lender might charge you an early repayment charge. In some cases, you'll pay that out of the money from the sale of your property. But there is another option sometimes, which is called porting. This is when you port or move your current mortgage from one property to your new property. So you don't repay your lender and take out a new mortgage with another lender. You keep your mortgage, you take it to the new property, and if that mortgage isn't enough to purchase the new property, you apply to borrow more with the same lender. Sometimes this could save you a lot of money. However, whether this is the right option for you will depend on your circumstances. It may be that there's another lender with a much cheaper deal, so overall it actually works out cheaper to pay your early repayment charge and take a mortgage with the new cheaper lender. If you were porting your mortgage, everything else works pretty much the same. The solicitor won't repay your current lender and then get money from a new lender. They'll just confirm with your current lender that your current mortgage can be taken to a new property. And that sums up briefly how to move home if you already own a property with a mortgage. If you have any questions, then please get in touch using the contact details below. Thank you.